students, today's live lesson will cover selected important topics from Lesson 6. I hope I can emphasize information that will assist you in comprehending the learning objectives and provide real-world applications. The learning objectives of each lesson are a useful tool to ensure comprehension of key concepts. First, let's briefly review the learning objectives of Lesson 6. After completing this lesson, you should be able to identify the roles of accountants in business, define the different types of accounting, identify the types and components of various financial statements, explain the use of various financial ratios, and explain specific issues related to international accounting. This live lesson will review the types and components of various financial statements, as well as the use of various financial ratios. Financial statements fall into three broad categories: balance sheets, income statements, and statements of cash flows. These reports indicate the firm's financial health and what affected it. The first financial statement that we will review is the balance sheet. The balance sheet supplies detailed information about the accounting equation items, assets, liabilities, and owner's equity. I will now describe each of these items in further detail. From an accounting standpoint, many companies have three types of assets: current, fixed, and intangible. Current assets include cash and assets that can be converted into cash within a year. The act of converting something into cash is called liquidating. From most liquid to least, current assets might be ordered as cash, marketable securities, and merchandise inventory. Fixed assets have long-term use or value, such as land, buildings, or equipment. As buildings and equipment wear out or become obsolete, their value decreases. Accountants use depreciation to spread the cost of an asset over a useful life in years, divide its worth by that many years, and subtract the resulting amount each year. Intangible assets have monetary value in the form of expected benefits, which may include fees paid by others for obtaining rights or privileges, including patents, trademarks, copyrights, and franchises to your product. Goodwill is the amount paid for an existing business beyond the value of its other assets. Current liabilities are debt that must be paid within 1 year. These include accounts payable, unpaid bills to suppliers for materials, as well as wages and taxes that must be paid in the coming year. Long-term liabilities are debts that are not due for at least a year. These normally represent borrowed funds on which the company must pay interest. Owner's equity, sometimes called shareholders' equity, can be broken down into paid-in capital and retained earnings. Paid-in capital is money invested by owners. Retained earnings are net profits kept by a firm rather than paid out as dividend payments to stockholders. They accumulate when profits which can be distributed to shareholders are kept instead of for the company's use. The second financial statement, the income statement, is sometimes called a profit and loss statement because its description of revenues and expenses results in a figure showing the firm's annual profit or loss. Profit or loss equals revenue minus expenses. A balance sheet shows the financial condition at a specific point in time. An income statement shows the financial results that occurred during a period of time, such as a month, quarter, or year. The income statement is divided into four major categories: revenues, cost of revenues, operating expenses, and net income. Revenues are the funds that flow into a business from the sale of goods and services. Cost of revenues shows the cost of obtaining the revenues from other companies during the year. Cost of revenues is relevant for service providers, but income statements for manufacturing firms use cost of goods sold. The cost of goods sold is the cost of obtaining materials, to make products sold during the year. Managers often are interested in gross profit, which is a preliminary, quick-to-calculate profit figure that considers just two pieces of data: revenues and cost of revenues from the income statement. Operating expenses are resources that must flow out of a company if it is to earn revenues. Examples might include research development expenses, selling expenses, and administrative and general expenses. Operating income compares the gross profit from operations against operating expenses. Subtracting income taxes from operating income provides the net income, which is also called the net profit or net earnings. The third financial statement is called a statement of cash flows, which describes yearly cash receipts and cash payments. Since it provides the most detail about how the company generates and uses cash, some investors and creditors consider it one of the most important statements of all. It shows the effects of cash of three aspects of a business: operating activities, investing activities, and financing activities. Cash flows from operations include cash transactions involved in buying and selling goods and services. Cash flows from investing include cash receipts and payments from buying and selling stocks, bonds, property, equipment, and other productive assets. Cash flows from financing includes cash inflows from borrowing or issuing stock, as well as outflows for payment of dividend and repayment of borrowed money. Here is a link for a video integrating all three financial statements in a quick but effective way. Statements provide data which reveals trends and can be applied to various ratios. Ratios are normally grouped into three major classifications: solvency ratios, profitability ratios, and activity ratios. Solvency ratios provide measures of a firm's ability to meet its debt obligations. Short-term solvency ratios measure a company's liquidity and its ability to pay immediate debts. The most common is the current ratio, which measures a firm's ability to generate cash to meet current obligations through normal, orderly process of selling inventories and collecting revenue from customers. A current ratio is calculated by dividing current assets by current liabilities. To evaluate long-term solvency, debt is divided by owner's equity. Sometimes a high debt may not only be acceptable, but also desirable. Borrowing funds gives a firm leverage, which is the ability to make otherwise unaffordable investments. Evidence of earning power is available from profitability ratios, such as earnings per share, defined as net income divided by the number of shares of common stock outstanding. Earnings per share determines the size of the dividend that a firm can pay shareholders. As an indicator of a company's wealth potential, investors use this ratio to decide whether to buy or sell the firm's stock. An activity ratio is a financial ratio used in evaluating management's efficiency in using a firm's assets. This can be applied to any important activity, such as advertising, sales, or inventory management. I have created a small Check Your Understanding section, similar to the online presentations, to help you verify your comprehension. You can review the answers on the next slide. Thank you for watching today's video. Please reach out to me via the chat room or email if you have questions. Have a wonderful day.